If you're over 40 and you've been watching this AI boom unfold, it probably feels familiar. It feels like 1999. The hype is deafening. Every company is suddenly an AI company, and every channel on YouTube is promising you that one more generic tech fund will magically secure your retirement. But you and I both know the truth. Hype doesn't build lasting wealth. Bottlenecks do. And right now, almost all the money pouring into AI is chasing the exact same stock everybody already owns, while ignoring the two physical choke points that actually decide whether this whole thing keeps running. In the last 60 days, Wall Street quietly launched two brand new funds that let you own those exact toll booths. One pulled in $5 billion in its first 25 days of trading. The other gives you access to machines so rare that essentially one company on Earth can build them, and without those machines, the AI revolution stops cold. Now, you need to understand the problem each one solves, because that's what decides whether they belong anywhere near your money. And stick around to the very end, because after the real maths, I'm going to do something most channels won't. Give you an exact percentage-based breakdown of how much of your portfolio funds like these deserve, whether you're 35, 45, 55, or stepping into retirement. Let's skip the hype and look at the math. Step 1. Now here we are going to look at the problem and where your money is going into. We think of AI as magical software living in the cloud, but underneath, AI is just math. Billions of calculations at light speed, and to do that math, a processor has to be fed data, constantly. Here's the secret Wall Street glosses over. The fastest processor on Earth is useless if it can't get fed fast enough. The industry calls this the memory wall. Chips have gotten so fast they now sit idle, waiting for data. It's like bolting a Ferrari engine into a car and then trying to fuel it through a tiny plastic straw. The fix is a specialized, brutally difficult to make component called high bandwidth memory, HBM, that sits right next to the processor. No memory, no AI, period. And only a handful of companies on the planet can make it. On April 2, 2026, Roundhill launched the first ever pure-play fund built to target that exact bottleneck. The Roundhill Memory ETF, ticker DRAM. Before this fund existed, owning the memory makers meant buying a broad chip fund stuffed with 40 companies you didn't want, or picking individual stocks in a notoriously brutal sector. This solves that in one ticker. It's actively managed, with an expense ratio of 0.65%, $65 a year for every $10,000 invested. On the higher side, but you're paying for surgical precision. And precision is the word, because this is not a diversified fund. It holds only about 15 stocks, and 3 of them, Samsung, SK Hynix, and Micron, make up roughly 75% of the whole thing. The rules cap any single company at 25%, so be clear on what you own. A concentrated bet on a tiny oligopoly that controls the world's memory supply. You get smaller names like SanDisk too, but those 3 are the engine. The demand is staggering. Micron's order books for this memory reportedly stretch into 2027. Money flooded in. $1 billion in the first 10 trading days, $5 billion within 25. At its peak, the fund more than doubled. But here's the reality check the hype channels skip. Memory, at its core, is a commodity, and commodity cycles can turn violent. This fund hit a high above $70 a share, then dropped about 15% down to the mid-50s in a single recent stretch, on nothing more than fears about interest rates and chip pricing. If hyperscalers like Amazon or Google pause spending for even one quarter, this fund will feel it hard. It requires a stomach of iron. Step 2. So we've got the memory, but how do you physically build these chips in the first place? We're talking about features the size of a few atoms. You can't carve that with ordinary tools. You have to use light. Specifically, extreme ultraviolet lithography. These are the most complex machines humans have ever built. They vaporize droplets of tin 50,000 times a second to create a flash of extreme ultraviolet light, then use it like a microscopic scalpel to etch circuits onto silicon. Without this, advanced chips simply don't get made. And increasingly, data centers are ditching copper wiring, which runs too hot, and moving to light itself to carry data. That's photonics. On May 6, 2026, a fund launched to own that exact transition. The ticker is EUV, the Corgi Lithography and Semiconductor Photonics ETF. It targets the companies that build the machines, the optics, and the photonics that make advanced chips possible. The expense ratio is just 0.35%, almost half what the memory fund charges, and it currently holds north of $200 million, making it smaller and nimbler. It holds around 40 companies, but the top names tell the story. The biggest is Taiwan Semiconductor at nearly 10%, the company physically printing the world's chips. Right behind it, near 8%, is ASML, the Dutch company that builds the lithography machines. And this is the part that matters. ASML is a true monopoly. No one else on Earth builds what they build. After that, you get the critical equipment players, Corning, Lam Research, Applied Materials, each around 5%. The top 10 holdings make up a little over half the fund, so it's focused, but far less of an all-or-nothing bet than the memory fund. Now, the honest part. And this is where the hype machine lies to people. Many of the individual stocks inside this fund have soared this year, some of them up triple digits. But the fund itself, since it launched just weeks ago, has been roughly flat to slightly down, and it just pulled back nearly 10% in a stretch as the whole chip equipment sector sold off. Those are not the same thing. Anyone showing you the holdings returns as if they were the fund's returns is selling you something. This is the price of admission at the bleeding edge. These companies hold the keys to the future, but Wall Street prices them for perfection, and when the economy flinches, they drop fast. So let's lay them side by side. Honestly, the memory fund is bigger, more liquid, more famous, but wildly concentrated and already run very hard. The photonics fund is cheaper and more spread out, but tiny, brand new, and actively managed, so you're trusting a manager's stock picking. And here's the single most important fact about both of them. Neither one has a track record. They were both born in 2026. They have not survived a crash, a recession, a full rate cycle, nothing. That is not a reason to avoid them. It is the reason they can never be your foundation. Which brings us to the question you actually came for. How much of your money should go into something like this? If you're in your 40s, 50s, or 60s, you lived through the dot-com crash. The technology in 2000 was real, but valuations got disconnected from reality, and people lost a decade of wealth because they didn't manage their risk. So we manage it. The framework professionals use is called core and satellite. Your core is the boring, reliable foundation. Broad index funds, dividend ETFs, bonds. Your satellite is the high-conviction growth sleeve around it. These two funds are pure satellite, never core. If you're 40 to 49, you've got 15 to 25 years to recover from a bad year. Your core should be around 85 to 90% of your assets. Your satellite bucket, 10 to 15%. And within that satellite, maybe 5 to 7% across hyper-focused funds like these two combined. Enough to move the needle on your wealth, not enough to delay retirement if the chip cycle turns to winter. If you're 50 to 59, you're entering the wealth preservation zone. A 40% drop in a satellite fund hurts a lot more when you're 5 years from retiring. Push your core up to 90 to 95% and hold these two to just 2 to 4% combined. At this age, it's not about hitting home runs. It's about not striking out. And if you're 60 or older, in or near retirement, the goal flips to preservation and income. Core of 95 to 98%. These funds get a tiny sliver, 1 to 2% at most. Money that, if it vanished tomorrow, would not change how you live. As for splitting the two, if concentration scares you, lean toward the Photonics Fund for its wider spread and lower fee. If you want size and liquidity, lean toward the Memory Fund. An even split is a fine middle ground. And to be clear, I'm an educator and a fellow investor, not your financial advisor. Do your own research and know your own risk tolerance before you ever hit buy. So there it is, 2 brand new funds, the 2 physical bottlenecks of the AI machine, the memory wall and the light builders. What's inside them, what they cost, what they've really done, and exactly how much of your portfolio they deserve at every age. A lot of you asked me to cover the memory fund specifically. This one's for you. We don't do blind hype here. We study the bottlenecks and we map the math. If that's the kind of investing you want, hit subscribe. The next one builds directly on this. And tell me in the comments, which bottleneck matters more for the next decade? the memory wall, or the machines that print the chips. I read every single one. Stay disciplined and protect your capital. This is Real Wealth Hack, and I'll see you in the next one.